All right. Good morning, everybody. So the Fed did a pretty good job yesterday of getting the market to sell off. If you go back and listen to previous morning briefings, we've talked about that's their intended goal right now. They want to get people to quit buying the dip. And every rally, they go out and make sure they got something to say, knock it back, get some prices down. If they can communicate their intentions well enough, the market will actually respond in such a way that they don't have to do anything with the rates. And that's why they'll often say, well, we're going to raise rates X amount. And then at the end, they don't do anything. I remember when I was newer, we used to like talk trash on the Fed and say, oh, yeah, no, you can't trust them. They'll say one thing and do another. But I really was missing the point that they would say those things and then the market would start pricing in what the Fed was talking about. And they would do such a good job of pricing it in that the Fed didn't actually have to do anything. So it's just really good communication. Well, really good compared to their history, right? Compared to the way it used to be. Um, we're looking at FX Street. This is where I like to go to kind of get a short little heads up on the dollar. Um, it's free. I've got subscriptions to Wall Street Journal and Bloomberg and others, and I'll go over there and hit up what they've got. BlackRock has its own little phone app and has articles that's worth checking out. Most of the big ones do. Right? You can go to their website, you can find their apps on phone stores, and they'll have just different articles that cover a variety of topics. You want to continue to hunt for anything that talks about the dollar, since the dollar on its own, just seeing it rise or fall doesn't tell us anything. We need to know, why is it rising? And I've done videos on that. This morning it's selling off. We will get into that, but want to start with something like FX, get a little perspective on the dollar, see what we have on the agenda today. Is there anything that's anticipated to be impactful within the market? Come over and look at the calendar. 8:30, 9:45, and 1 o'clock. Now, after working on the rigs for 20 years, I do not see how the number of rigs is going to impact our market. Not in today's world. So it's useful to know, I guess, but we don't expect any impact due to the rig count. Now, if there was a real crisis on liquidity, that number may, affect things in the bigger picture, but they're still holding a lot of reserves that they can release, and there's global reserves that are being released, and so this number is not expected to be very impactful at all. So I'd say by 10 o'clock this morning, we're free and clear of any impact from economics. And at that point, it would just be who's out there chipping their teeth this morning. And is there anybody expected to talk? And at what time are they going to be talking? And that'll be what we want to focus on. There's a lot going on with the European central bankers, and that's something to keep track of. So we're looking at the daily chart of the S&P, and it's important to just go out to those higher time frames, take a peek, see if there's anything out there. Very often, I think you'll see that there's nothing there, but that's okay. If you don't look, then I guarantee you'll never find anything. But if you do go out and look, you may occasionally see something that gets your attention. We're back under the 10, and so far this morning, we're continuing to move away from the 10. We want to keep our eye on that. Again, we've talked about it before. When price gets, quote, too far away from the 10-period moving average, it likes to pause there, consolidate and wait and let that moving average get caught up with it. Or if it becomes impatient, it likes to pause there, turn around and go back where it came from. Go back towards the 10. Look at the 10 like the mean or the middle or the average. Yeah, it's a good way to look at it. So when we're below it, we want to continue to ask the question, are we moving away from it? Are we moving towards it? And same thing when we're above it, how far away are we above it? Have we gone too far away from it? Which is why I built that indicator. Distance from moving average, so that we can ask those kind of questions and actually get a real number to put on there. Right now, we're nearly 1% away from the 10 period. That's not even close to the average on the year for this year. So we could expect that it could go down a little more. I had a lot of people asking questions yesterday about how far we had fallen. And it's true. I mean, we moved a long ways, right? We went from the top of the box to the bottom of the box. We broke some critical levels. We actually did what I had said yesterday was the least likely scenario, but it was one of the scenarios, right? And one of the reasons that we moved so far so fast is because it was the least likely scenario. It caught a lot of people off sides. And when people are long and they're off sides, they got to buy to close or they got to sell to close. And that selling fed into the selling. It's always easier to buy than sell, right? Because if you're trying to buy, there's always somebody willing to sell you something. And we've all experienced that. There is always somebody willing to sell you something. But when you're the seller trying to find a buyer, oh man, that gets a little more rough. And we're not even just talking stock, right? We're talking anything. You got a car you're trying to sell. Damn, it's hard to sell it. You got a house, it's hard to sell the house. You got futures and the market's falling. It's really hard to find someone to buy that. Stock doesn't matter. So we're outside the box. We stabilized along the lows. Have we moved too far? No, we haven't moved too far. Remember that everything has a measured move. The distance that we were expected to move for the week, higher or lower, is this box right there. So last week, we had the line high and the line low. And we said, you know what, in the next 5 days, the market is very likely to move up at least this high and go down at least this low. But by the end of the week, we should still be within this box. And here we are on Friday, still in the box. We haven't gone too far. In fact, since it's Friday, the indicator is already drawing next week's range. And one thing that we can note right off the bat, it's one of the nice things about this indicator, is look at the size of this week. We call that the box. Look at the size of the box. You just take that box and put it on next week's. We came up a little short, right? Yeah, that's what she said. The box for next week is bigger because there's more volatility pricing into the market for next week. That's why the box is bigger, right? So just at a glance, we can see, oh, hey, market makers are pricing in more volatility. Now, that may not be very impactful since there's very few of us that trade options on futures. But if you did that same thing on SPY or the QQQs or Apple or whatever you're trading, take a look at this week's level of volatility and compare it to next week's level of volatility. And if it's a bigger box, that's straight up telling you that those options are more expensive now or are pricing in to be more expensive than they were the previous week, right? Because volatility makes options prices go up in their aggregate. Yeah. All right. So, same scenario, same situation. It's the same question we ask all the time. What do we got on the agenda today? What could the market do? Well, right now we are presenting in a classic flag pattern, but I've come to argue about this classic flag that if it's going to be, well, let's look at it from a couple of points of view. Flag, right? You got trends like that, and we'd say, oh, there was the flag. And then it gets to the next point. Oh, there was a flag. And the same thing to the downside, that there was the flag. And then it pulls back and it drops again. And we'd say, oh, yep, there was the flag. But in those kind of scenarios, every time it continued, right? And what do we have in a trend but a bunch of micro flags, right? That's literally what a trend is. It's just a bunch of micro flags. So what happens when we start to consolidate and we do not go lower? We don't get lower lows. Hell, we don't even get equal lows. And we start to build a very large base along those lows. At what point do we say that this is no longer a continuation pattern, which is a flag? A flag is a continuation pattern. We have the expectation that price is going to continue in the same direction. If this was going to continue in the same direction, why has it not started to continue yet? What's it waiting on? Where's all the sellers, right? And the same argument would be made if we were going to the upside and then paused in this really tight consolidation pattern the same way. We'd be asking the same question: where's all the buyers? So when we base for too long, the argument starts to be made that this is not a flag pattern anymore. It is a failed flag pattern. Now, it has not failed yet, right? It would not fail until we actually break out of the top of this thing and we start going the other direction. So like a move to the upside. And if you think about what that would end up forming, you would end up with a cup. And of course, along the way, you would get those micro pullbacks, those flag patterns all the way back up until you get to the top. And then perhaps you'd get a handle on that cup. So right now, we don't have any of that, right? We just got the base and we have a lack of continuation. So we want to watch this morning and see if we're going to get that continuation to the downside, or if we are done moving to the downside and start to get that upside move. One thing I like about the Busby is kind of the implication of what it stands for. So with the Busby, we want to see price break through the top of the range. And instead of just running all the way back up, we want to see it break through the top of the range and then pull back and validate that old resistance as a new support level. Now, the range that I usually use is the Fibonacci, right? Just 786 to 100. That's my channel. That's my base. You can see it doesn't line up perfectly with what price has been doing. Even if we try to adjust it, maybe we don't use the wicks, right? We only use the body. It still just doesn't quite line up the way we want it to. I don't try to make the Fibonacci fit what I want it to fit. I just put it where I normally would put it and I call it good, right? And if it doesn't line up, it's not because I drew the Fibonacci wrong. It's just because price isn't lining up in there. With a visual, you could use something just like use the box. The highest point of the Globex this morning and the lowest point of the Globex this morning. That is our base. So if we're going to expect a reciprocation back up to these previous levels, then we need to break out of the box, maybe get a Busby, and then continue working our way up. We're going to be looking for anything that we could hit along the way as signposts or warning areas or places of concern. and we would look to reciprocate back up to the previous levels. I find that unlikely, right? Now, this is a very, very tight range this morning. The initial balance is really, really small, and the entire range is really tight. So, one thing that we could say is it's very unlikely that we're going to stay within that range. Okay. So, if we don't stay within that range, while we want to talk about it, we want to note it and recognize it and say, yeah, it could do that, but it's unlikely. So, that'd be scenario one. What else you got? We could break out of the top, begin that failed flag play, which would eventually lead back into a cup with maybe a handle, maybe not. If we were going to make that kind of run, then anything to the left with, say, volume profile would be important to note. Whereas the value area low, we would have to get through that. It also lines up with a lot of volume right there, so it'd be something worth noting. Then we get into a shallow area, and we start getting back into resistance around 44.25. There is a cog line at 44.11, but it's a very shallow area where that cog line is, so I don't expect any resistance there. And the third scenario would be that we go to the downside. Now, keep in mind, this isn't COVID, right? COVID was an uncontrolled drop to the downside with madness and chaos behind it. People were running redemptions on their hedge funds and on money managers, telling them, hey, I want my money back. And that was causing the fund managers to sell things they normally wouldn't sell. Everybody was selling everything, and it was just dumping uncontrolled, willy-nilly madness. Even gold was going down, right? Because banks were getting margin calls and had to sell their gold to cover their other trades. So it was madness and chaos. This isn't that. This is not that at all. It's a slight pullback. We had a slight pullback back here, right? Nothing to it. The only thing that is interesting or even noteworthy is the speed and the pace of the drop. The distance, we did not go too far, right? We didn't go too far. We didn't go too fast. So just relax, breathe, take a breath. There is a floor down here around 41.20-ish. And if we get around that floor, there is an expectation that we would um, pause in this descent, maybe kind of hang out and stabilize. It would take a lot to continue driving this market to the downside at this point. Could we go down there? Yeah, I mean, price can do whatever the hell it wants. We can go down there. We won't go that far today. But we could continue that move to the downside. Since March 14, right around the time that the Fed came out, we got that rally in Apple and the FANG names. We rallied back up to the top of the box, and now we're just ending the cycle and coming back down towards the bottom of the box, right? That's it. So that's it. Something noteworthy to kind of get hung up on is we had started to get a little bit of that reversal. We talked about it the other day. We were starting to get higher highs and higher lows from this downtrend. So it was trying to turn the corner and go back up towards these highs. And the Fed is going to go into silent mode soon, right? Every time they are going to have one of their FOMC meetings, they have to go into quiet mode before that. So he came out and had one last smack at the market, trying to get us to sell off a little bit, to quit buying the dips, to end this little rally to the upside. And he did a pretty good job, right? That's what he set out to do. It's funny when they do the FOMC announcements, we used to always say it was Operation Don't Rock the Boat, that he would come out and his lips would move and he would say a bunch of words that His entire goal or intention at the time was to say things without ever actually doing anything or moving the markets at all. That's what he normally would do. Now he is deliberately throwing fireballs at the market, trying to get this thing to sell off. And the market's doing exactly that. It's pricing it in. You can go look at tips and you can see that they're pricing in these more aggressive rate hikes. Not because the Fed actually is going to have to do all of those rate hikes that they're talking about. They probably won't have to if the market prices them in. They may have to do one or two of them, but not all of them. And so the market's just doing, it's just responding to what he did. It's not a crisis. It's not a crash. So where could we go for today? Well, we talked about the upside move reciprocating back towards that 5,000 level. We've got an ADR of 1.5 and we're basically flat on the morning. So from here, we could breach that low of 43.56 and we could begin moving to the downside. Even if we had an exaggerated move and we price in a 2% move today, that should put us right around 4,300 in the S&P. That would be our downside move for today. If it starts to get extreme, and we can price in extreme. Say we get a 3% move. That's twice the ADR. That would put us at 42.50. Now at that point, we'd start getting to the edges of a little too much, right? The low that was projected for the week is 4,300. So if we go to 42.5, we would be just outside the box to the downside. But we were just outside the box to the upside earlier this week, and there wasn't anybody freaking out about that. So we don't want to see any freaking out about this one, right? I'm not saying we're going to 42.50 today. We're just examining the market and asking, well, where could this go without being moving too far, too fast, or overextended or oversold or any of those phrases that I don't like to use. Now, one thing of note yesterday when I was looking at this, in green here, we're looking at the volume yesterday, right? This is volume by price. Where was the most amount of volume? That's where the red line is. We call that the point of control. The most amount of volume is very, very low. It's all the way down at 43.90. Well, we didn't spend an exorbitant amount of time there yesterday, right? That was the latest part of the day. It was in the afternoon. We got there around 3 o'clock. So in power hour, we were in that zone or in that area. And the bulk of all of the trading yesterday was right there. You know what I mean? Like in the entire 22 hours yesterday, 1 hour of trading in power hour is where all the biggest amount of volume was at. If you look at how much volume we had all night long from the Globex open all the way through until the market opened, there was a lot of volume there. And that's over 12 hours of trading. And this 1 hour down here was more than all of that. That's a lot of volume. Also, while we're at it, look at those levels that we talk about all the time. Institutional pivot points, we call them. So this is yesterday's, when it was yesterday, this was the day before's low, right? Between Tuesday and Wednesday. We would mark that low, carry it forward. Look at the amount of volume that was at that level. Notice that it's underneath the pivot point. It's not on the pivot point. And this is what we talk about all the time. If we were looking for a bounce here, we wouldn't try to go long right on the pivot because the liquidity is on the other side of it. I hear everybody talking about supply and demand. Where's the volume at here? It was underneath the pivot, but just slightly underneath it. It's a critical institutional pivot point. We pay attention to these levels. Now, it didn't hold. We went right through it and just kept on going. But price absolutely responded there. And look at how much trading activity there was there. That's why we carry forward those levels and look for them in our trading session. All right, for the Nasdaq, same situation. We had a lot of volume right down there at the level. Right now, our current point of control matches up with yesterday's point of control. It's right on time. It's exactly where we would expect it to be. In a move to the upside, we can expect some resistance around 13.8, 13.9. Wow, you mean round numbers really impact the market? Gee, imagine that. 13.95, shallow area, and then around 14.100, right? Those are just high volume levels. You can look back beyond that and see if they match up with an institutional pivot point or not. But that's what we would be focused on for an upside move. What if we were to continue the move to the downside? Then we would deal with our own Globex low first, yesterday's low, then the low from last week, which would put us around 43.55. And it's worth stopping and asking the question at that point, how far down would we be with our current minus 15 added to this? That would put us near a 1% move to the downside. Okay, I mean, it's not very much for the NASDAQ. You can see that there is a floor here too, just like we were talking about in the S&P. So 13,000. I find it unlikely we're going to make it to that level today. We've got an ADR of 2.5%. So if we priced in that 2.5%, that would get us right around 13.4. In the grand scheme of things, we're right back inside the range. Nothing unusual, nothing to see here. And if you wanted to check out the range for the week, we're still inside the box, right? We got the weekly expected move, 13,529. And if we wanted to ask that question, what about next week? Well, here's the size of this week's box. You can just take that box, drop it over to next week, ask the question, is next week holding more volatility than this week? Yes. The next week's box is bigger than the box that we were in. They're pricing in more volatility. And like I said, you can do that on equity products, things that you would actually be trading options in. It would give you some insight into the options pricing model you're going to be dealing with. Take that in with skew, put call ratio, put call parity, liquidity. So this morning, the dollar was moving around significantly. We had an exaggerated drop in the gold, liquidity break. Nice run up in the dollar, kind of topped out this morning and rolled over on us. Is right up back to that 101 level again. The bonds are acting like stock did the other day. If you remember what Monday looked like in the market, up, down, up, down, up, down again. So really want to keep our eye on the bonds this morning, see if they start to tell a different story. Right now, this is a little odd and a little exaggerated. We are starting to see the NASDAQ lead in the market, right? When we're normally, I would have the four grid here, the four horsemen. We'd have Russell, Dow, NASDAQ, S&P, and we would be watching those four to see who's leading the pack at any one time. I replaced the Russell and the Dow with gold and Bitcoin due to the crisis in Russia and the inflation that's going on. So we look at gold as a hedge against inflation, and we've been watching Bitcoin due to the restrictions on the ruble. So we just adjust a little bit on the charts based on world events. But at the moment, the Nasdaq is leading and the S&P is following behind. We really want to watch for a highly correlated market, right? One of the reasons that we moved so far and so fast yesterday is because the market synced up and correlated. It's in a highly correlated market state that we can make those really big, exaggerated moves. Oil, bonds, dollar, these three have been really insightful over the last few weeks. They're going to continue to be for quite a while. When I see the bonds sitting at resistance, I start looking at the S&P and the Nasdaq. Are the stocks at resistance or are they at support? Now, oddly enough, they've been moving in the same direction together, right? We've been seeing stocks and bonds going up together, stocks and bonds going down together, and that ain't right. It ain't right, but that's what we have, right? So whether it, whether it's right or not, we have to just recognize that's what's going on. And generally speaking, I when I see them doing that, I start looking for them to decouple for an opportunity. I look for both of them to get to a resistance and one break through while the other not, or to get to a resistance and one to break through and the other not, and that becomes the opportunity. Watch these things. They are the best indicator that you can use right now. All right, so look at the FANG names this morning. How many of them had uh, a significant break through that consolidation zone like NVIDIA had, right? We had a nice wrapped up consolidation zone, hard break to the downside. Same thing with Google, nice consolidation zone. Had a IX10 forming up really nice here and then break to the downside. Now, we were actually talking about what the market did after the dot-com bubble when tech stock fell out of favor and we had that great cyclical rotation back into um, very large institutions and oil and things like that, right? Back when like Lehman Brothers and big oil and tech was like an afterthought. We take that afterthought for a moment and start looking at things like Netflix. Netflix went from what, $700 to $218 in less than a year. And if you're thinking, well, yeah, but I mean, that's a fluke, subscriber numbers. All right. What about Facebook? We went from 380 to 180 less than a year. Well, I mean, yeah, whatever. PayPal, 310 down to less than 100, right? To $90. Now, it's easy enough to look back and say, yeah, but it's too late. We already missed that. Thanks, Captain Obvious. All right. Gotcha. How about Google? Google hasn't made the fall yet. If we were to do the technical analysis on Google and ask the question, where's the downside break? What's the downside target here? Even if you just use a basic range tool, the first stop in Google is 1954. Now, that's not too bad, right? We're still well within lines, but that's just a simple range tool from the highest point to this low value peak. If we were to kind of cut that value a little bit more, 1540, 1500 comes into play. About Amazon, 2150 is the target. NVIDIA, Target 1, 140. Target 2, $70. Yeah, the box that you see on this chart here, this green line and this red line, that is the weekly expected move. We get that weekly expected move from here, right? We look at what next week's weekly expected move is. So there's next Friday's, it's this. So we take that number and we look at the closing value Friday night at the close. We look at what the cost of the market is, add that number to it, and subtract that number to it. And that's what we were doing, right? We're doing that manually for a long time. And then a guy named Mobius said, "Hey, why are you doing it by hand? And if you don't get it on the weekend, you have to use the go back and take the market back to Friday at the close, and then you have to use the go back level just to be able to get your numbers. And there's a lot of markets out there. How are we going to do that efficiently?" So Mobius decided that he could create an indicator that would draw those lines for us. Now, technically, you can use it on any market out there, but it was designed based on the SPX trading. And I've got videos on this thing explaining it in detail, blah, blah, blah. I don't want to go through it again and again and again. That indicator is in the Discord that I use to share all the indicators. The Thinkorswim workbook. It's got over 1,000 indicators. I keep saying that, but I've added a lot since then. So I think the number is probably closer to more of like 1,500 indicators. They're not all indicators that I've made, like that weekly expected move. I didn't make that. The link for this Discord is in the Bullish Bears Discord. So if you were to go to that Discord, scroll down to the Traders Resource Zone, you'll see there's custom scripts, custom charts. You get to poking around in there, and you will see that there is an invite to the Thinkorswim workbook. All right, so what do we got going on this morning? We want to look at the S&P 500. I want to change this to pre-market. We don't want 500 names, so we're going to try to get that down to 100, which is kind of tricky to do. 92 is good enough for me. This thing on its default won't respond unless the market has moved 0.5%. So we get a lot of these gray boxes. We're going to clean that up a little bit. Just hit the 1x and drop it down into a tenth. Now it's more responsive. It's not seeing anything differently, right? We didn't tell this thing to do anything to find things differently. We just told it change the color sooner, right? The FANG names really stand out: Microsoft, Google, Apple, Nvidia, Amazon, Tesla. They stand out because how big their box is. The box that is represented is based on their market cap. That's why you see some boxes that are really small, some boxes that are really big. So we're looking at this morning, and it stands out that finance is squishy or soft or weak or really not responding or moving around that much. So we're not negative in finance, which is helpful, but we're not really positive there either. Now, if we're going to get a rally in the market, we have to have tech or finance. We have to. It's got to be one of those two. Tech or finance is the only thing that can get us to rally. The FANGs can do it, but the FANGs are tech, right? So that just falls back into the same argument that says it's got to be tech or finance. When you can get both sectors moving in the same direction, say to the upside, then we can really get a rally. The thing is, the Nasdaq 100 doesn't have financials in it, right? So if it's only the financials giving us the rally, it's very likely we'll get a bifurcated market, the S&P moving up with the Nasdaq dragging its feet. Well, we know that's not what we were seeing this morning, right? We talked about it a few minutes ago. The Nasdaq is leading, and it makes sense that the Nasdaq is leading because the financials aren't really moving around yet this morning. They're not negative, which gives us hope for the S&P, but they're not advancing, so they're not helping. They're just not hurting. Things that aren't really useful to us this morning: um, healthcare, energy, consumables, retail. So let's swap this off from the S&P 500 to the Nasdaq 100. We don't need to use any kind of filter. We're already at 100 names. We just want to adjust the color scheme a little bit. Again, the FANG names stand out. They're the very large boxes, and areas that aren't really doing anything this morning stand out because they're the gray areas. So it's not looking that bad out there. We could almost look at this and be bullish this morning. I would not be bullish, right? Be very cautious on that, especially when you think about how far they moved down yesterday, right? Linear regression, mean reversion, dot plot statistics coming back to the average. If we dropped fast yesterday, then at the very least we expect some form of a pullback. And whether we go up from here or go down from here, the pullback is expected. And that's kind of what we're seeing priced in here, right? A little bit of a pullback, some mean reversion. Now, one thing that I like to use this screen for in the morning is to quantify, well, how many companies are up this morning or how many are down this morning. So on the negative side of things, in the S&P, and it's interesting, we can use S&P 100, but over here I couldn't use S&P 100, right? So I don't get to pick and choose. That's one of my disagreements with this platform. But if we're looking at the S&P 100 and we ask, well, how many names are down this morning? At least a half of a percent. That's what we're looking at here, right? S&P half of a percent. It's only 10 names. Well, that's not bad. That's 10% of the S&P is down a half of a percent. That's a negligible amount. It is worth checking the sector and the industry that they belong to. I do see that there's now, I see American Express has got earnings, so we're going to discount that one. All right, we'll look at the other ones: transportation, health, technology, communications. Okay, you know what I mean? Like the couple stand out. Nothing really bad, nothing major. What about the Nasdaq? Right? How many names in the Nasdaq are down at least a half of a percent? And what sector or industry do they belong to? Retail, consumer, a little bit of health technology, and I mean that's a wrap, right? So what about the positive side of things? We did see some green in there for the Nasdaq 100, up at least a half of a percent, 10 names. So again, a very negligible amount. We're not seeing anything that really stands out and says, "Oh, we should focus on this sector or that sector." And one of the reasons that we use this in the mornings is because if we were to get one of those really good, strong, powerful trend days, it very often comes with a highly correlated market, right? So if we come in the pre-market and we can make a statement that says 80% of the S&P is up at least a half of a percent this morning, that would be very bullish. Even that bump to the upside we had yesterday before everything dumped, that little fake breakout is a very common tactic, right? We see this all the time. Short little bump to the upside lasts about 30 minutes, and then oh boy, away we go. In the book, The Art and Science of Technical Analysis, it's written by Grimes. That book is also in the Discord. He talks about how major institutions will slowly liquidate out of their positions in something, say like Apple. BlackRock owns over $9 billion worth of Apple. If they wanted to reduce their exposure to Apple, they couldn't just go in and sell, right? They would drive this market down into the dirt. So they can't do that. They have to slowly sell out. They will sell the rips instead of buying the dips. They'll slowly ease out of their position. That way, you see a consistent move, slowly grinding lower instead of just big monster drop candles where everything is on fire and spooking investors. It's not like they want to cripple this market, they just want to reduce their exposure. And that little bump to the upside is often connected with some sneakiness, right? They'll reach out to their friends at MSNBC and, oh, hey, talk this market up. Talk about how good this is and blah, blah, blah. So they kind of talk it up in the pre market. It's up in the pre market. Everybody's kind of bullish. What goes into the open, retail's buying it like crazy. And of course, while retail's buying it, the banks are the ones selling it to them. Here, you can have my position. I don't want it anymore. So the banks are liquidating out of it, and then they roll it over and dump that thing back down. It's not rocket science. And that book was written a long time ago. We still see the same things today as the guy who wrote it saw probably 20 years ago. It's the same play, right? So, what are we going to do this morning? What are we going to focus on today? I find it unlikely that we're going to be able to lean into the sectors. We're going to want to use our watch lists today, which for me means using that high-low scan. I really love that thing. It has the most nonstop trade opportunity signal I've ever come across. Like it never stops all day long. Oh, you need a trade? Here you go. Oh, you need a trade? Yeah, here you go. Here's another one. Love that thing. Probably going to want to lean into that. The only adjustments I ever make to it now is what basket of stocks I point that thing at, right? And we've been using the CBOE liquidity list, right? The list that says what was the most heavily traded products for March, because this is April. We want to look at March, and we go and we get that list. Now you can be more responsive and get like what was the most heavily traded stuff last week, and then you get that list. I don't like to cycle my list that much, but you could. There's videos that I made on that, and I shared the thing. It's in the Bullish Bears large caps. Just use the pin in the upper right corner of the Bullish Bears Discord in the large caps and type in high-low graph, and you'll see the video that came up where I explain what the damn thing is. I point out where an article is so you can read more about it, and then I shared the scan and the indicator, or basically just the scan, right? Because the indicator is a watch list column, so it's not much of an indicator. So what's up with the sectors, right? Which sectors do we have that are even looking good? Well, it's been energy and finance for me since like January, and I don't think that's going to change today. I'm going to be really focused on energy and finance again today. When we don't have those, we still have the indexes, things like SPY, the Qs, right? We always got those. And especially today with the 0 day, we absolutely have one of those. Um, a lot of these other ETF names, I wouldn't really care to trade. Things like XLK, EEM. I just use these to for what they represent, right? We can look at emerging markets and say, well, this is our global risk on gauge. If this is up in the pre-market, then we've got global money in a risk on attitude this morning. In a risk on attitude, we've got global participation. Okay. Or the marijuana sector is looking really good this morning. It's up, 1.6%. But these old school legacy indicators or legacy sectors, they miss the modern world that we live in, right? Things like the EV market or crypto. How's crypto doing this morning? So we want to go in and look at crypto. I got this little homemade list of stocks. I didn't pull this list out of my head, right? This list of crypto names is the names that make up the crypto futures basket on the Smalls Exchange. So that's where these names came from. And we can look at those names. We see kind of a mixed bag. Some are doing good, some are not so good. Notice it's not crypto coins. It's companies that either are heavily vested in blockchain or are heavily vested in coin or both. Some of these names look like they're doing pretty good. Some of them are also on that beatdown list from yesterday, like PayPal and Nvidia. So it would make sense that some of these are green just from that mean reversion flip back. What about semis or chips? Yeah, those are looking really good this morning, only on the basis that they got whacked really hard yesterday, right? Look at that move to the downside and the mean reversion back in the other direction. The range has been clear: high, low, high, low, high, low. Hey, we're at the lows. What do you think we're going to do? Go up from here. Now, we don't have to. Trust me when I tell you, we do not have to. We could break and go lower here. But looking at the chips this morning, they're looking pretty good. My benchmark is 0.5%. And if you look a little bit closer, you'll notice that a lot of these are not even close to 0.5%. They're just slightly green. Well, slightly green don't mean nothing to me, right? We want them to be better than that. How's the EV market looking this morning? Same thing. We just gather up a lot of those EV names, because if we can't get a legacy sector into the S&P, right? Because it's like your 11 sector legacies, they've been around forever. We got to make our own, like the EV here. And we can see that a lot of these are up more than that 0.5% this morning. Li Auto, Ride, NIO, Tesla. But what about the legacy names like Ford and GM? Not so much, right? GM's in the downside still, and Ford's barely positive this morning. One thing that you want to spend time on this morning is asking what went up yesterday. That's a short list, right? A lot of things were down yesterday. What did not go down yesterday? Because it's very likely to go down today if it went up yesterday. And things that were down yesterday are likely to go up today. Fed swap prices in 4 50-point basis rate hike in September. That news just hit FX Street. I'll post that into the large caps for you guys. And Fed swaps price in a 250 basis point rate hike by the end of 2022. So they're not on silent mode yet, right? They're taking one more swipe at the market, trying to get it to sell off a little bit more this morning. This is a deliberate push against the market to make sure we don't get that bump to the upside this morning, right? They're wanting to make sure this becomes a dead cat bounce and that we make that next leg lower. Now, I'm not telling you to run out there and short everything, for goodness sakes. Let it play out and then take that opportunity. But don't be surprised if we now break yesterday's low and continue the next leg lower. With those two bits of news hitting the wire this morning, it would not surprise us a bit if that's what we end up seeing. So look at the sectors. You could gauge them for your activity, but I think they're not going to be very helpful today. You're probably going to want to just run your own watch lists and use the 0 days. Unfortunately, I made a video on the 0 days on Wednesday and the audio didn't work. So I'm going to remake that video today. I should have it to you guys by the weekend. I think it'll really help, right? Because a lot of the questions that I'm seeing from people are based on the idea. I can just see it in the questions. You've only seen it done one way, or you've only done it one way, and you're really struggling with it. And I cover it in the video. I got you covered, right? Show you a better way to do it. I'm looking for, what the heck is that thing called? Aha, okay. So I showed this last night when we came in and we did analysis of yesterday's price action, did this last night in the chat. I'm not sharing out this screen yet. It's not much different than the other screen that we use all the time anyways. This one just has the VIX 9 in it. Um, so it's pretty similar to the other one. It's just not the other one, right? You can make it. There's nothing in this that is special or unique. We got the Nasdaq, the S&P, we got the cumulative market tick comparison, the regular tick turned into a line chart with my own little scribbles on there, and the VIX 9. So it's the same grid that we normally would use. Just looks a little different. This would be the other grid, right? The advancing issues in the Nasdaq, advancing in the S&P, the Nasdaq, the little homemade FANG names, conglomerate and a symbol, right? You just use the plus sign between every name. You could put as many names in there as you want. And tick, cumulative tick. So those two announcements that just came out at 8 and 8:15 are significant. They kind of changed the game, which is why I stopped and came back the other direction. Let's kind of reevaluate this for a little bit. If they're going to continue to move these Fed swap prices, you're going to see it very likely break this low. Now, it's funny. In the last few days, we've seen a lot of those discussions where we say, well, it wasn't supposed to do this. It was supposed to do that. So, I'm going to talk it out. And if it does completely the opposite, then it'll be like, yeah, when what should happen doesn't, which is an actual phrase that we focus on. When what's supposed to happen doesn't happen, what do we do with it? Like when stocks and bonds are moving in the same direction. It's not supposed to do that. Yeah, but that's what they're doing. Literally right now, the bonds are moving up, stock is moving up. It's not supposed to do that. Yeah, but it is. So shrug it off and deal with it. With this Fed swaps pricing in 250 basis point by the end of the year, that should have us breaking back to the lows. And yet, after that news came out, we're still moving to the upside. We're still in Globex, so don't let that shock or confuse you. Be ready for another one of those 30-minute bumps to the upside with a dump back down. If it doesn't do that and we get that bump to the upside and we just continue to go up, great, fine, awesome. It's just not doing what it's supposed to do because they're literally pricing it in. It's just right there on the wire. We still have the three scenarios, right? The ones that we went through right back at the very beginning of all of this. We can stay range bound. It's highly unlikely. We could break through the top and reciprocate. That's the most likely. And then to the downside, we break down and hit those other levels. That's what I got for you guys. Be careful, be safe. Have a good one. And I will see you all the morning briefing next week.